Oh, okay. And hopefully you can hear me okay. I'm not sick. It's just, I guess, pollen in the air and I'm losing my voice here. But good evening, everyone. I'll introduce myself and then we'll introduce my colleagues up here. But my name is Tom Singh. Believe it or not, I had to do the math the other day. I've been a wealth advisor at Merrill Lynch for 22 years. I'm starting to get some gray hairs, my wife says. So finally, it's been a long time coming. But basically with my practice, what we've done in the last probably 5-7 years is really focus on working with entrepreneurs and their exit planning. I've known Sanjay, gosh, 20 plus years working with you and your law firm, and went from being really generalist to narrowing it down. And so now working particularly in the technology space, really all industries, but in the last couple of years, you can imagine all the transactions going on in the technology space. We've been spending a lot of time and getting involved with people 12 to 36 months before their exit. So it's great timing that we're having this conversation tonight about tax hacks on what to do from a tax planning perspective long before you're ready to sell. There's a misconception out there that I can't tell you how many times my phone rings last minute and someone says, I just signed an LOI, I need some help, and by then it's way too late. We'll get into that here in a few minutes. But I am a local resident here in Dunwoody, so I live about a mile away, and pleasure to be here and great to be part of TiE. I want to introduce Jason. So Jason is with Aprio. He is the tax expert here, so we're going to defer a lot of the tax questions and the hard questions to Jason. Jason is a graduate from the University of Alabama, Cincinnati Bengals fan. You're from Cincinnati originally as well. Married with 2 very cute boys I saw on your website. Not that I'm stalking you. Yeah. Okay. I saw one of the cool things that you wanted to do was travel to every major league ballpark with your kids.
Yeah, so that, well, one of I guess a life goal, I guess, is to go see every major league baseball park with my 2 boys. So they're 6 and 4 right now. So I think probably this summer we'll start the journey and go to every stadium. I don't know if it's by the time they go to college or when, but we want to get there. So we'll make it.
So he's with Aprio. He's a tax consultant and specializes in transactions, particularly in the technology manufacturing space. And there was one vertical as well, I think, other than that. Are those the 2?
Yeah, yes. I sit on what's called our MIT team, so Manufacturing International Technology. So mostly manufacturing tech clients. Those are global industries, so inbound and outbound international companies.
Great. Thanks, Jason. And then we have John Marsh. John is with Marsh Creek Advisors. He is an M&A advisor for small to mid-sized companies. So if you want to talk a little bit about yourself, you are a University of Georgia fan. I went to University of Florida. This is a very sore spot, a very sore subject for both of us to be in the same room talking about this. But he's also a local Dunwoody resident as well. We've done some good collaboration together and become a good friend over time. So yeah,
well, I'm a little disappointed that you didn't ask me about my daughters or but Tom has become a good friend, and in spite of that weekend in October where the dogs dominate. But no, I'm glad to be here. I'm an M&A advisor helping businesses successfully transition ownership, and love working with Tom, and thanks for having me today.
Great. So before I get started, just wanted to see if anyone has anything that they want us to cover as we go through. I'm just going to fire some questions, and feel free to chime in if you have any questions in the crowd as well. Before we start, maybe what we do with you, John. Let's start with you. Kind of think big picture about, there's a lot of things in the news with rising interest rates, and so a lot of people probably have questions on their mind, like what's happening in the marketplace, what you're seeing, because I know you're active right now on a bunch of transactions. What are you seeing in the M&A space right now, just to give everyone a level set of what?
Yeah, it's obviously things are changing, and multiples are coming down. Some may say they're coming back to reality. But let me answer that question with two examples. One, I took a commercial residential tree company to market last year, $4.5 million or so in EBITDA, and the market was hot. Private equity still sitting on a ton of capital then and today, and we got them a deal. Now, for personal reasons, they decided not to move forward. They came back to me earlier this year and said, you know what, we're ready. So we went back to that buyer. We had already run a process. And that buyer immediately said, yes, we're back. But let's retrade on them, or let's revisit them. Now, my job is to push back on that. I said, you know what, you're taking us off the market. We're not running another process. So up that offer. And they did. But that's the kind of things we're hearing from private equity. They're going to put some debt on the deal. That debt is more expensive today than it was. So multiples normalize it, coming back to reality, but deals are still getting done. I said 2 examples. That's one for that topic. The other example I'm anticipating. You did not throw me that question in advance.
Sorry, sorry to prep for that.
But it's still hot. It's still deals are still happening. I will say those small SBA deals under 7 million, a lot more constraint there because you're relying on unproven individual buyers, and that bank debt is significantly more expensive than it was.
Gotcha. No, that's very helpful. So, transition a little bit to you, Jason. When you're dealing with structuring a deal for different entity types, can you talk a little bit about between what the difference might be in a C corporation, S corporation from a taxation perspective? And, a lot of the people in the audience, maybe early, mid-stage, we got some late-stage people in here as well, right? So just kind of keeping that in mind when you talk to that.
Just out of curiosity, who's a C corp, S corp, LLC?
I didn't want to read. I don't want to read
S, C, S. Any particular reason you're an S?
Lower taxes for me personally.
Yeah.
Are you 100% owner of the S?
No, I have a partner.
Okay. Anyway,
Avoid double taxation.
yeah, yeah.
For me, it was that they told me that is the best way if you're gonna raise capital to use the S. So we did. I don't know.
So somebody told you the best to be the S was a good way to raise the capital. I'm surprised somebody said that. I mean, I think I would have a different argument.
Yeah.
I would have a different argument. Coming from the tax, I think that's the hardest, but so.
But for an M&A, it's better to be a C than an S.
I mean, not necessarily. So there's different ways to structure the deals, no matter what structure you are. So if you're a C corp, there's a couple of different kind of options that we see a lot, and that's you do a stock for stock deal that can be tax deferred. So if you just exchange stock from your company into another company, can be tax deferred, versus if you took cash just 100% sales. I'm gonna just take cash for my stock. That would be a taxable transaction. Or you can have a hybrid, so you can maybe sell 75%, get 75% cash, and then 25% kind of roll over in the new company. And so maybe one of you guys want to talk about 1202 as it relates to that rollover.
But as far as the proceeds are concerned,
Right.
Well, one thing I want to flip back and ask you, right? Because I think we were kind of going back between the S and C corporation. Let's answer that first real quick. Is there one that is better, the S or the C? And then maybe I didn't put this in our question list, but can you talk about qualified small business stock? Because I'm surprised a lot of people still don't know what that is, but in the technology space, maybe there is.
Yeah. So the original question back. Sorry, what was the original question?
It's better to be an S corporation or C
Oh,
corporation.
so it doesn't, in the grand scheme of things, it doesn't matter if you're a C or an S. There are different ways to structure the transaction in either case. So if you're an S corp, you can drop your assets into an LLC and sell interest in the LLC, or you can sell your S corp stock, and you can have what's called a 338H10 election, which means the buyer is actually buying the stock of the S corp, but you're selling your stock, but the buyer's having an asset transaction. So the buyer gets what's called a step up in basis on that transaction. So take, for example, just high level thinking, if you sold your business for $2 million, the inside basis of the assets were $500,000. Then that 338H10 allows the buyer then to depreciate or amortize depending on the assets inside the business. And they can take that $2 million as a write-off, as opposed to they would, in a stock transaction, they would potentially only get the carryover of the 500,000. So that $1.5 million delta is a benefit for for the buyer in that 338H10 scenario. If that's in both a C and an S scenario, so it doesn't matter in any other one of those.
John, can you expand a little bit on that, right? In dealing with buyers that are coming to look at a company, what's their perspective on doing an asset sale versus a stock sale?
Yeah, it's a good question, and that's often something that we educate our clients on very early, right? So an asset sale is not necessarily, a lot of clients think, oh, they're buying assets of the business. Well, they're doing that in the stock deal too, right? They want the business. How it transitions and the tax implications are very big here. So it's important in general that we have these conversations at the beginning. But to answer your question directly, stock deal, there might be IP or something in the business that needs to transfer. Contracts are a great example. If you've got this wonderful contract, the buyer's going to want to alleviate hurdles to re-sign that contract as a new entity. So they will likely push a stock deal. Now, on an asset deal, the big benefit to the buyer is they're not assuming liabilities that happen pre-transaction. So let's say there's some kind of bad actor that you weren't aware of about pre-closing. That bad actor can sue the new entity. Well, it's the same entity and the stock deal. So an asset deal allows buyers some protections on those risks that transfer with that could transfer. I feel like I jumbled that because my brain was spinning after his explanation. But the point there is it's important to know that buyers may want to structure a deal a certain way based on the assets that they want to acquire. And to give them the best options, you need to position yourself today with the correct legal structure so that that option is still available. And it's important to call people like Jason at the beginning when you form your company and say, hey, I'm going to sell this eventually. The reality is every business will transfer. What protects me now? What structure allows me? I heard taxes. What allows me to minimize my tax implications today, but also gives me the best way to transition this asset later down the road. It's a key question when you're forming a business, and that's why don't do it on legals. Call a guy like Jason, call an M&A attorney.
Does the multiple change one way or the other for a seller? Like it's an asset sale also,
So we've been renegotiated a couple times based on what they're getting. Let me give you an example. We had a Section 338 election. It was a stock deal treated as an asset deal for tax purposes for the buyer, for the seller, excuse me. And we could not find the S election form. Minor thing. You all get it when you file your when you incorporate your business, register with the IRS. That deal took 3 extra weeks. Deals are stressful in general. Everybody's emotions are high. It's your baby that you're selling. You're on, and there's a lot of money at stake. That 3 weeks was very painful for my client. We got it. It was no issue, but it was an admin hurdle that could have easily been overcome if they were organized on the front end, formed the company the right way, had conversations with experts. So I don't know if that answers your question. I tend to ramble.
How early should someone engage in a good attorney before a transaction?
Well, when you start the company.
Yeah, right. You
It's,
should be working with a good tax and legal advisor from the onset of formation of your company. And there can potentially be a lot of cleanup if things aren't set up properly and you haven't documented things properly. So it's important from the onset.
well, and let me answer that a quick question too. On some of the smaller deals that we work on, business owners have engaged a CPA who is inactive. They send you the request list in November. They remind you again before the extension, and then you send them the information. They ask you a couple of questions, and then boom, you get your tax return. Right? That's not a hands-on. Just like there are levels of M&A advisors, of tax partners. You need to find a business advisor team of advisors who are well versed in transitions, who know what goes into selling business. So this client, when I reviewed his information, I said, "Hey, you're a C Corp. You know that, right?" He goes, "Yeah." I said, "What's that mean?" And well, from my limited knowledge, it means it can be taxed twice. You've got tax on the business, you've got tax when it comes to you personally. Let's reach out to your CPA and have a conversation. This email we got back from the CPA was the most confusing thing I've ever read. And it said to me, he doesn't know what he's talking about. So let's find somebody who does. And at that point, we call in a guy like Jason, we call in an M&A attorney, and it costs more money, right? You might pay $500 an hour instead of, or $800 an hour instead of $250, but you'll save that in spades when you go to sell it. So again, ramble, but
No, that's perfect. That's great. I'm going to ask you a question again. It's not on my list here. Can you talk a little bit about the advantages of C corporation on sale? Because I think, again, getting back to the original question of S corporation, everyone does it for personal taxes. Can you talk about the qualified small business stock qualification, what that means to a business owner and how that might be beneficial?
Yeah, so the qualified small business stock, basically it's, if you're investing in what's considered small business, so $50 million of gross assets and below, you can exclude either 10 million or 10 times your basis of the stock that you sold, right? So if you're the original founder of your company, right, you're a C corp, let's say well, I'm going to bring them in as shareholders early on. So it has to be initially from a company, right? So on the initial offering from the company. So the three of us now own shares of stock. So if all three of us then go sell those shares in the future, and if we sold it for, each of us sold it for $10 million, I'll just use an easy example. We sold the company $30 million. Each of us got 10 million. We can exclude that gain under what's called code section 1202, qualified small business stock. But the only catch is you have to hold it for 5 years. So you can't acquire it 1 year and then go off and sell it the next. So you have to actually hold it for 5 years. But it is an advantage to a lot of people. I use 10 million as an example, but there are ways, it's kind of complicated, but there are ways that you can actually exclude that gain in excess of the 10 million. So just kind of be mindful of that as well.
So that's a great, go ahead.
Only for C corp, that's only.
C corp.
C corp. It
Yes.
has to be a C corp, and it has to be actual stock. It can't be, you can't hold convertible debt. Right, actually, you physically have to get stock on initial issuance from the company when the company's gross asset value is below $50 million.
So one of the things that Jason's referring to, our team, we do what's called wealth structuring. So we don't draft documents, we don't give it legal advice, but we can prescribe different structures. And so what he was mentioning is the first $10 million may be exempt from capital gain. There's another method that you can do called stacking, to where you can gift shares. Let's say you have a spouse. So, and let's say you sell the business, then let's say, Jason gets a $10 million exemption from taxes from capital gains, and the shares that your spouse has now, their portion is exempt from $10 million in capital gain. And let's say you have children, et cetera, right? So you can see how you can really stack these entities on top of each other to get around the capital gains exposure.
And that's in all in addition to the 12 or 13 million, that estate transfer to the kids.
So we're talking capital gains tax. So you
Yeah.
just stole you just gave me a great video, because that's where I work with people like Sanjay, right? So the other piece to that, we're talking about corporate taxes. Now we get sort of in the personal tax realm where we kind of step in and talk through from the estate tax. So if you're not aware, whether your company is sold or not, doesn't matter, okay? Anybody in America can pass along $13 million to their family, right? As of today, without their family incurring any taxation for that inheritance, we'll call it, okay? So if you're married, that's $26 million. One of the things that's not being talked about, and a lot of people don't realize this, and especially when I tell my parents and my family about this, is that exemption of $13 million is currently in the tax law set to go to $6 million in 2026. Doesn't need a vote or anything like that. Sanjay, I don't know what your thoughts are on that, but we're hearing we won't make any decisions whether that's going to change until probably after the next election in 24. But if I was a betting person, let's face it, taxes are probably only going one way, and that's probably not lower. Right, let's be honest here. So at worst case, let's say it stays the same, it's 6 million. So you may say to yourself, well, my business isn't worth 26 million today. Okay. And you say, I'm not really worried about that. Well, if that drops to 6 million, now you only have 12 million combined between you and your spouse, right? If you're married, if you're single, it's even worse, right? You're limited at 6. Part of what we do is run a projection on your business and your net worth to see, okay, if you do nothing and you grow your business at a very modest rate, what is your exposure? Because if you never sell your company and you're not liquid, when you pass away, the IRS does not care whether you have cash or not. They say, oh, I'm so sorry for your loss, kids. We need you now to file a death tax return, right? Basically an estate tax return on your family. And I'm so sorry. Oh, by the way, you're a business owner. Like now they start licking their chops, right? And you have to get a valuation on the business. And that is included, whether it's sold or not, right? So that's going to be part of your estate. And technically that money is due in 9 months of passing. And so if you don't have a liquidity, you're going to have to sell some assets, sell part of it, whatever it might be, to come up with a payment plan, whatever it might be. So there's things that you can do to try to protect your money from that estate tax. So one of the methods that we've been spending really the last 36 months on, like straight on transactions, is you are allowed to get an estate tax valuation on your company. So let's say my company today is worth $50 million. This is actually a live case that we did. It was worth $50 million. We went and got an estate tax valuation a few years back, and we got the valuation actually at a lower rate. And you say, well, why would you do that? The IRS says that because your company is not a readily marketable security like a stock, they don't know the value of it. So they allow you to give a discount to the value of the company. Now, this is a valuation that you want it to be low. No one else is going to see it but you and the IRS. And then from there, what we did was we got a valuation of about $10 million on this company from an estate tax perspective. We then took the shares that were 100% in the husband's name. We gifted 50% to the spouse. So now the wife has 5 million of shares. Husband has 5 million of shares. They then gifted money into a trust for each other and froze the value of the estate at that $5 million amount. So now let's say they never do anything with the company. It grows to $1 billion. The IRS, because you're filing a tax return showing that you made this gift, it's frozen at that $5 million. So it can grow to $1 billion. Doesn't matter. Now your whole family has saved a tremendous amount of money from the estate tax, which is taxed at 40% of the amount above that exemption. That is 13 million today. So hopefully that made sense. There was a lot of circles there, but that's the type of conversations we're having. Because the other thing that also happens is now those assets in the trust are protected from lawsuits and divorce. So let's say your kids inherit that money in these trusts, and God forbid they get divorced, right? If they weren't in trust, they could be subject to divorce proceedings, right? Taking half your money. Well, now this money is in trust. It stays in your bloodline. So you can imagine when you're going through these transactions, it's very important to talk through these items here. So anybody have any questions on that? Because I know that was pretty technical there.
That was amazing. Thank you, Tom.
Thank you. Thank you. I appreciate it. All right. A lot of people don't believe in the estate tax. There is an estate tax. They will find you. Oh, here's the other thing. With a lot of South Asian families I deal with, they will find your assets overseas as well. Right? Somebody's shaking her head. Damn. Just because it's money, you've got land in a family member's name, they will find you. So it's not, that is not estate planning, right? Putting money in assets overseas or thinking that in a different jurisdiction, you're going to be able to hide anything from the IRS. They will find you.
Tom?
Which chairs, but I'm gonna ask a question to you.
Yeah.
How new is this one? How new is what you have?
Oh, this is pretty basic. I mean, doing a trust like this, a spousal lifetime access trust, is pretty common trust.
But the sunset of the estate tax.
Oh, that was 2017. The new tax laws that came in, that was a compromise to say that by 2026, some of these provisions will have to sunset, and that was one of them.
Well, and I'm leading the witness here.
Yeah.
Right, it's important to have a team where you're having these conversations. We tell our people we speak with who are not ready to sell, that you need to have the conversation every 3 months, grow or exit. Now, obviously, a lot of us are in the growth phase, and that's wonderful. But you also need to have this de facto board of directors where you're having a conversation with a person like Tom, with your attorney, with Jason, at least once a year, asking them what's changed, what are the things that I can take advantage of. Active participation in an eventual exit is so important, and the folks who've done that through a plan and talk to folks like even me, what are you seeing in the market? What are drivers of value is important. So even if you're not ready for an exit, be thinking about these things and calling the team.
Yeah, and ideally, you'd want them all on the same phone call, right? Same Zoom meeting to be able to bounce ideas. That would be ideal situation.
Collaborating.
Quick question, Zoom as well. Okay, go for the input.
Kids and their wife still can't touch it if you're divorced.
Correct, yeah, it's protected.
Ah.
Irrevocable trust.
If I only knew, right?
Yeah,
Somebody want to ask something in the.
yeah, go ahead, ask a question virtually here.
Yeah, thank you. So I know that we touched upon the S Corp and the C Corp aspect of things just before. So Jason, where do you think if you are doing a startup, you should start? Like, do you just go with the LLC? Because I know that when we were trying to raise money, we were told that, kind of build a C Corp. That is easier to kind of raise money, but I'm now hearing even S Corp is possible and raise money. So can you give some guidance as an early stage startup? Like, how do you kind of structure this right from the get-go? Thank you.
You catch that?
Yeah, I think the general question is, as a startup, what entity type is best on formation? I think in a nutshell, right? Is it?
Yep.
So we typically advise clients, at least on initial formation, lots of times it's best to just go ahead and form and be an LLC, be a partnership if you have a dual member setup, with the intention that if you're going to raise money in the future. But if you're a closely held business, maybe you don't want to have access to multiple funding rounds or something like that, maybe you'll just be an S Corp because of the different tax advantages. And C Corp, people get this misconception that C Corp's the best route to go. C Corp is fine, there's no issue with it. But you don't have to, the only reason people would pay you to go into C Corp is they feel like that's the best way to raise money. Right? If you're the startup and you're the founder, typically you're the one contributing the money into the business. So you want to have the benefit of getting the losses. If your losses maybe are profitable and that's great too. But on initial formation, typically you're losing money. So it's better if you're getting the benefit of having those losses. So if you're a C Corp, the losses stay inside the company and you're not really getting a benefit for that. And on a transaction or in the future, if you were to sell 50% of your company, there's what's called a 382 limitation. Sometimes those losses can be limited inside the C Corp. So it's better to be an LLC and not pigeonhole yourself into one of those kind of C Corp structures. You can always convert to a C Corp down the road. So lots of times if you're going out, you're gonna call John over here and you'll want to sell your company, and whatever reason the buyer wants you to be a C Corp. It's very easy to convert an LLC to a C Corp and ultimately sell the C Corp. That buyer could also set up blocker C Corps, what's called a blocker C Corp, that then they actually invest in your LLC through this blocker C Corp. So one way is not more beneficial than the other per se, but there's different ways to structure a deal when you ultimately get to that point. But
just two quick follow-on questions, very quick. So first one, if I'm an LLC, how do I ensure that I'm able to still issue stock options to my employees, raise money? Can I continue to do that? Like, I think that is the biggest point of confusion because the internet is full of misinformation, if you may.
Yeah, so you can still issue equity awards in an LLC. So you can do it a couple of different ways. You can set it up as an option. You can issue options of LLC. But lots of times people give what's called a profits interest. So you can give profits interest. So what a profits interest basically is if you lock in the value of your company today, let's say it's on initial formation, it could be zero. But maybe it's $5 million. Let's just use $5 million. So if I issue a profits interest, my company's worth $5 million. Basically, what that means is if you have the three of us are partners of this partnership and you want to bring in a key executive and give them profits interest, where you set his profits interest threshold at $5 million. And let's say I go and sell the business for $12 million. Well, the three of us are going to profit off that first 5 million. And then the next 7 million is when that profits interest person starts participating. So if you give a profits interest, there's a threshold so that we're not diluted in the value that we've brought that company up to $5 million. So the profits interest then is in and above that. You can also give restricted units in an LLC, which is similar to restricted stock. And then you can also do what's called phantom equity, both in C Corp and a partnership. So what a phantom equity basically means is I can give you, I'm not an actual owner of the business. So it's on an exit. So my kind of $12 million exit scenario, let's say I have a phantom equity in there that it's almost like a bonus payment. So somewhere along the line, I sell $12 million. Let's say this phantom equity entitles them to 2 million. So then they're going to get the first 2 million, and then we have the next 10 million. So it's almost like you're giving them a bonus on that transaction price. So they're not actually an owner in an LLC scenario. You're not actually giving them a K1. So they're not actually owning any physical stock or owning physical units of the LLC.
Well, let me touch on that and ask you a quick question. We see a lot of transactions that include phantom equity. And the payout for that phantom equity is often structured as a stay bonus for those employees. Continuity of the team is obviously very important in the transaction. So that phantom equity structure allows them to participate in the exit, but also you can put them in some golden handcuffs. Obviously, we all want them to get paid, but we don't want them to get a $2 million check at closing and then say, see you later. If your deal has an earnout or some kind of contingent back end payment, that could be a risk if those employees want. So just something to happen.
Yeah. And that's why you'll see different structure that you've seen. And we structure something with a note payout in the future to keep people around, or you do an earnout to keep people around. So there's different ways to keep those sellers to continue to grow the business and have them entitled. And it happens a lot in the rollover structures as well.
Great.
Thanks very much.
This is a question from myself again. I get this a lot about changing residences. Does it make sense to go to a non-tax income tax state for estate taxes, right? The other thing is, like, I have a couple clients, actually a few clients, and I'm seeing a bigger exodus of people moving to Puerto Rico, an Act 60. You've heard of this before. Can you talk a little about maybe those two items at all?
Yeah, so I see Act 60 a lot with my cryptocurrency, digital asset clients, right? So they're the ones that are on Act 60. So what Act 60 is, and I'm certainly not a Puerto Rican tax expert, so this is kind of my limited knowledge with speaking with people there. But basically, what Act 60 does is I'll use somebody that had basically a high net worth individual that's invested a lot of money in crypto, and maybe let's say they got in early. I said they're worth $100 million today. Now they want to go move to Puerto Rico and become a Puerto Rico resident. So if today the value of their digital assets is $100 million, well, they lock in the value of that digital assets at $100 million. And now let's say it grows in the future to $150 million. So if they sold everything, liquidated everything for $150 million, they would pay $100 million of tax in the US when they left. And that $50 million increase, then I think the rate is zero in Puerto Rico. So then they would pay zero tax on that $50 million excess. So that's the Act 60 Puerto Rico scenario. And again, I've only dealt with it in the digital asset space. I don't know if you guys have. I've seen it in a different context.
That's what I'm saying. I'm starting to see a lot more of this. I'm starting to get more and more clients that are moving to Puerto Rico. Their income tax, and again, I'm not a tax person. I'm just telling you from my conversations and interacting with them. Apparently, there's no income tax as well if you adhere to the law of Act 60. So their business is incorporated in Puerto Rico, zero in taxes. You have to live there 183 days out of the year. So they're living in Puerto Rico, and you're seeing a whole expat community moving to Puerto Rico for that tax benefit. There's some other nuances and requirements there, but it is very beneficial, and it is, you're right. These people are actually in a digital marketing business, really fascinating. 2 college dropouts to 40 million in revenue, living it up in Puerto Rico in digital marketing. But you're right, a lot of crypto assets as well.
And so while Puerto Rico is a US territory, it is a foreign country for US tax purposes. So you just want to make sure you're following all the proper foreign guidance as it relates to moving assets to a foreign country and all that out of the US and into a foreign country. So it's not just I can just move my business there kind of tax free. So you still have to value the company on transfer down and deal with all that as well.
Right. What about moving to Florida, Texas, Tennessee, right?
Yeah, I mean, look, people do it, right? I mean, there is a benefit there. I would certainly people be hesitant if you move there and then 30 days later your company's selling, right? I mean, I think, you know, as long as there's some gap in there that you're not doing it just to avoid any sort of transaction tax-related items. I mean, but you have to do it properly. You have to change your driver's license. You have to register to vote. You have to prove that that's where you're living. That's where you're a resident, right? You can't work in Atlanta and be in Atlanta for 200 days of the year, but like you're claiming that you live in Boca Raton, Florida, right? So I mean, you physically that's your personal residence. You can commute back and forth, that's fine, but you know, you have to set up all the proper documentation to go to a different country. And Georgia is very aggressive in tracking those addresses, because we do border Tennessee, we do border Florida, and so they do monitor that, because and states are getting more and more, they're following this more and more, that more and more states, we have to report people's driver's license on the actual tax return. So they have to put their driver's license number, the state that is registered in, and when it expires. So I mean, states are trying to catch people from doing this. So it's you just have to make sure you do it properly and with enough in advance of a major exit so that you're not doing it just strictly to avoid tax reasons.
Right. Well, that's great. What about some due diligence items during a transaction, during a sale? Some things to be mindful of.
Yeah, I don't know what you've seen over the years, but just a couple. A major item that I see that comes up a lot is sales tax. Sales tax is the biggest probably issue that comes up from a transaction, especially in light of the new Wayfair case from a few years ago. So I don't know if anybody familiar with the Wayfair case. So Wayfair, the furniture company, you guys probably know the online furniture company.
My wife doesn't know.
Yeah.
So basically what Wayfair, so the state of South Dakota took Wayfair all the way up to the Supreme Court. And basically the Supreme Court put charging sales tax into the hands of the states. So now states can assess kind of minimum thresholds for what generates what we call nexus in a state. So basically what triggers a filing requirement in their particular state. So and now all states across the board have different rules and different requirements for what triggers that sales tax. So it's typically a dollar threshold. So say 250,000 of receipts in the state, or it's a minimum number of transactions. So maybe 100 transactions, 150 transactions, 200 transactions, whatever, into a particular state. So that's a big piece, and it's allowed them to kind of change their whole mindset on what also qualifies it could be subject to this. So I know previously, like SaaS companies might not have been have to charge sales tax on software companies and that service component of that. But the states have kind of changed their rules now and kind of brought in a lot more businesses that qualify and would fall under that. So it's a big pressing item that people get under, and it can reduce your sales tax, the price the company will pay for your business. So like they'll set up an escrow or a reserve or something like that, or to dock the price of the business. Do you see that a lot?
Yeah, we see, I'd encourage everybody to look at a hypothetical situations from a transaction. Think you're selling your business for 20 million. That number quickly goes down with indemnity escrows, 12, 18 months on those tax related issues. So yeah, we see the indemnity escrows a whole lot. When you start talking about state and local tax issues, that's when I pick up the phone and call you. But it all impacts the deal, to your point. And it's nice to model those out well in advance of an exit, so you know your number. Selling a business is yes, it's about legacy. Yes, it's about your people, but it's about money. It's about how much money are you going to put in your pocket at the end of the day. And it's not this sticker price, right? There are tax implications that we've talked about. So I'd encourage you to model that out with your advisors, so that you know what you're going to walk away with, and do it well in advance, so that a guy like Jason can tell you, hey, maybe there is a reasonable change to the structure here. Tom can tell you about different trusts and things that you can do. But you can't do that while you're in due diligence. You can't do it. It's usually too late when you've hired me.
Okay, speaking of, sorry, well, while you're on that, talk about, because I'm sure people are getting unsolicited phone calls. Right.
Yeah.
So, a little bit sidebar off the tax component. So what happens in that scenario? Why is that dangerous for people thinking about selling?
Well, you've only given me 5 minutes. So it's a big issue. We see it a lot. Private equity, or you're all probably getting phone calls from strategic and private equity buyers, and that is a great compliment. And you should take it as a compliment, and only that. And I say that a little bit in jest. A lot of them are serious buyers, but you control the process. You control your exit by running a competitive process. A lot of folks say, "Oh, I don't want to hire an M&A advisor who works on a success fee because you cost money." We will pay for ourselves in spades by running a competitive process, driving up the value, getting you better terms. Right, $20 million can be structured a ton of different ways. 50% earnout with unreasonable hurdles. That's not a $20 million deal. And they say that on the sticker price. So we're going to create a marketplace so that one buyer, they can participate in it, but they're going to sharpen their pencil and they're going to come to you with a real offer. So don't get taken advantage of by, and they're good people, but they're in this to get a deal. Control the process.
Yeah, so morbid curiosity, I get a lot of these. So, and you get different kinds too, and I did, whatever, I don't really delve into it. But one of them is like, hey, I'm looking for one company that I want to get involved with. I'm going to come and I'm going to run it for you. And then we'll, go hand in hand and you're going to get a big exit out of this. I mean, what are they trying to do? And what's that person most likely about? Like what?
Yeah, they're about getting a deal. Those are acquisition entrepreneurs. When we take a business to market, everyone signs a non-disclosure agreement, then we get on the phone. And we ask questions directly at those folks. Are you funded? How much capital do you have? Not commitments. How much do you personally?
What's the difference? What's the difference?
In committed capital?
And funded, right? That's a big.
Yeah, so we've got a deal we're working on, but both of our deals that are over 25 million are with private equity groups that are funded. They've got committed capital. Now that doesn't mean they've got a $500 million fund sitting in the bank. It means they've got partners. They're going to do a capital call. Hey, we've got this deal. We've got an agreement. You send us the money. We consider that funded. That's the best private equity group.
So you're seeing some of these people, they don't have any money at all.
They're going to go check your LOI. They're going to put you under LOI. And then they're going to go shopping. They're going to find someone to give them the capital to do it. And if they don't have skin in the game, and a lot of them don't, that deal's never going to come.
Or it's all earnout funded by.
It's all earnout. I mean, I read something the other day that was like, oh, I buy businesses and the seller finances 100%. I mean, if you've got a struggling business that's worth nothing, go do that, right? If they're bringing something to the table, but we work with businesses that are valuable, right? We don't work with them, right? So those folks, I rarely put them in front of my clients. Because if it's a good listing, we've got funded private equity firms or those who are family offices, they've got the money. Deals 70, what's the number? Either 60 or 70% of deals fall apart after an LOI. Maybe even more than that, right? It's a fragmented market, we don't know all the deals. But they fall apart for a variety of reasons. One of those is because the buyer cannot come up with the money, or they come up with half of the money and then they come back to you and say, hey, my offer's changed. Yeah, I'm passionate about that.
Question.
It's hard to hold some of the very key technical folks nowadays because there is a big flight risk, as you know, the good ones.
Yeah.
And some of the experts are talking about, or at least this has been around for a while, but they have been suggesting that a lot of technology companies adopt some kind of partial ESOP, not the full ESOP, but a partial ESOP. What are your thoughts about that structure or taxation?
No, I think it's a good idea. I think you had mentioned earlier about phantom stock plans as well, right? I think it's a very commonplace thing to do to incent key employees to stay in place. Absolutely. Very commonplace. Question. Sorry, Sebastian. We got running out of time?
No. I was
Okay.
gonna say, I got a question from Sid Mukherjee.
Oh, yeah.
He's virtually right now. He said, thank you for an informative discussion. Should prep for a sale be different when there's a dip in the economy?
No, always be ready. So I assume we're referring to this,
Yes.
right? And sure, things have slowed down, but the M&A market was at historical highs for 2 years. Deals are still getting done, and you can't always control your exit. Something could happen to you, God forbid, disability, a death. So you always need to be ready to exit. There are many factors. I try to qualify my buyers and understand what is next for them. It's not always about getting the best deal, right? It's like playing the stock market. I wish I would have bought Apple in 2008, but I didn't. It may still be a good buy today. I don't know. But the point is, don't get caught on that. I've got to sell at the peak. If you have a financial advisor who knows when to sell at the peak, you're hiring. The same with your
They
business.
will not be financial.
Right.
Yeah, they'll be in Puerto Rico. So you always need to be ready. It might not be the right time for you, but you're still ready. And I have this conversation a lot with sellers of scale. Those businesses that are doing over $1 million in EBITDA, 5 million in EBITDA, those are still going very quickly, and they are still trading at very healthy multiples. So the M&A market is not always the same as what you see on the NASDAQ or the
It's a great point. Question.
We guys talk about how to avoid the exit treating your the sale proceeds as capital gains versus ordinary income. What steps you need to take earlier after that?
Sure. What kind of structure with the deal to be capital gain versus ordinary income? You want to take that one?
Yeah, so if you sell stock in a C Corp scenario, stock is always going to be capital gain. So if you're a C Corp, you're selling stock, that's capital gain. Well, when you run into a scenario like if you're a partnership or LLC taxed as a partnership, you have to be careful. Typically, even if you sell the business versus selling your partnership interest, it's always going to be treated as an asset sale. I said that backwards. So if you're selling the assets of the partnership versus selling your partnership interest, for tax purposes, it's still treated as an asset sale. And you have to go through what's called a purchase price allocation in both scenarios. So you actually allocate the purchase price to the assets of your company. And anytime you have what's called a hot asset, which is like, so if you're a cash basis taxpayer, that could be accounts receivable. So or if you're not in that cash basis taxpayer, that gets thrown out. But you could have depreciation recapture. Depreciation recapture could be ordinary income. Or like if you have deferred revenue in your business, that could also be ordinary income. And everything else typically then becomes capital gains. You have to work through a purchase price allocation. And that's a negotiation as part of the deal. I don't know if you see that a lot, but but it can be a sticking point sometimes in deals too, because it impacts the amount of ordinary income that the seller picks up. So they want to negotiate the purchase price allocation to get them as little into what we call the hot asset buckets of those fixed assets and things like that, to get a lot more into the intangible asset bucket, which generates capital gain for them. So it's important to kind of make sure you know what you're negotiating to get that more into the intangible asset bucket.
Sorry to interrupt you, but if I could add, oftentimes the buyer and seller are misaligned when it comes to those structures. So I've got clients who say, I want a stock deal. Well, yeah, everybody does. But buyers are not necessarily buying the stock of your company. They may want to step up basis, do whatever, all the stuff he talks about that half of it goes over my head. But point is, they're misaligned. So you've got to do that analysis with your advisors. Say, what does a hypothetical purchase price allocation look like? We'll be happy to do that for you. We do it on deals all the time. But just know that you can't always control whether you want it to be a stock deal or an asset deal. And if it's a stock deal, there's likely that 338 election, which then treats it as an asset, for tax purposes, as an asset transaction. So just know that you can't control all of this when you go to sell.
What about the earnout? How's that treated on the back end? Is that income or is that still capital gain?
Yeah, no, so typically it's going to be capital gain. It's going to fall into, it's different in an earnout scenario versus like an installment note scenario. So the earnout typically is going to be kind of all capital gain at the end. And if you have a transaction with an installment note component to it, or a deferred note aspect, you can elect this installment sale treatment. So you can spread out the basis of your assets to each of the different payments that you receive. So if you get like 75 today, 15 next year, and 15 the following year, you can spread out your basis across for the cash that you receive. But the caveat is, in any of those hot assets or the ordinary income pieces, you have to pick that up on the transaction. You can't spread that out over time.
And just to add to that as well, 10% of businesses are sold for all cash. So it's not if you have that deferred structure, it's when you have that structure. Because there will, and that's not what you're saying, but point is, every deal has some kind of earnout or seller note, installment, or both, right? So when you got a $10 million asset, it doesn't mean it's selling and you're getting $10 million.
And I'll say this also, talking about the phantom stock plans, things like that. So some of these key employees, they're thinking that whatever stock they're getting, sometimes it's considered like a bonus or a profit sharing payout. They think that's going to be capital gain, but it's taxed at ordinary income, if I'm correct, right? If you're an employee and you're getting a payout. So for example, if you have a president running your company, right, that person doesn't have any shares in the company, but they're getting a bonus payout based on the transaction. Those people don't realize, they think, oh, it's capital gain, and no, it's ordinary income.
Right.
Sure, good point.
And
Does it differ from a service company versus say selling widgets? Or is it the same? You started this.
yeah, no, I mean, there wouldn't be really any difference. It's just the type of asset that you have that you're really allocating to. If you're selling widgets, you're probably more asset intensive. So maybe people are actually buying your equipment and things like that, versus if you're a software company or something like that, you probably don't have a lot of physical assets that they're buying. So a lot of it is an intangible asset, so you wouldn't have as much recapture hot asset 751 items in that scenario.
Well, that's a great question. A lot of my clients, especially those who are in some of the trades, think, well, just make sure it's all put to goodwill. Well, these purchase price allocations have scrutiny. They're subject to review by the IRS. So it's not as simple as just saying, oh yeah, let's negotiate that. No, we need to protect you so that they're not coming after this money. And so anyway.
Great. Well, I know it's been an hour here. I don't know how much time we have. Sebastian, you got any questions coming in from the
I
internet?
do, I
Okay.
have one right here. It says, what's the typical multiple that you see for SaaS companies at the peak a year ago versus now?
I'm sorry, who'd you point to?
You-
So, I'll just be candid. I don't like quoting multiples. Because we do research. We subscribe to a ton of databases. And without understanding, a lot of folks say, and I don't need to punt on this, but I'm going to, how much of that business is actually SaaS recurring? Some of it might be project-based, and there's a different multiple.
Industry
But that-
vertical, right?
Yeah, so customer concentration, all this stuff, owner dependency matters. I'm not seeing that much compression though. To answer the question directly, not seeing that much compression right now.
Yeah, I'm in the middle of a transaction right now and they're getting 5x revenue. It's pretty sizable.
Yeah,
Yes.
and that's, he said 5x, we're normally talking adjusted EBITDA.
Right.
He's talking revenue.
Revenue,
That's a big number.
So it's still out there. So the point is, for the right company, you got the right company, there's still money out there looking to find a home. I don't know if you hit it on at the beginning, talk a little bit about private equity, venture capital, right? What venture capital probably not as much, but private equity, sort of the ecosystem, because these funds have raised capital over the last few years.
Well, let me give you an example on a
Yeah.
deal we're working on now. We've
Okay.
got a process on a coaching business. They train executive coaches. It's a one W-2 employee company. Okay, he's got 11 1099s. That's $5 million in EBITDA and adjusted EBITDA. It's not really an adjustment. So hugely profitable business. We ran a process on that. And these private equity firms are, and I'm very clear, we're running a process. We have 3 management calls this week. Well, I get text messages right after the call, hey, when can we debrief? But what they're doing is they're telling me, what can we do to get this deal off the market, right? And that's the process we run. That's what we want. We can't do it in every deal, but these solid companies, this is the process we run. And that's why we pay for our fee multiple times over. Take control of the situation. Anyway, the point is, we may not retrade on price. It's a fair deal. My client likes it. He's happy with the money. He knows his number. It's much more than that. So we're not going to over negotiate the deal. But what we are going to say is we're not going to ask you to increase your price. But we're also going to be very clear that the LOI price and terms are the LOI price and terms. Otherwise, we walk and we go to plan B. We also go to plan C and we have a plan D. So we have power in that transaction. And knock on wood, it'll work. I'm very confident about this one. I'm happy for my client, but we've got a long way to go. This is a marathon, not a sprint. So point there to answer the question, private equity is still very active. They're still doing what they can to get deals. And when you build a competitive marketplace, you increase prices.
Yeah, if you think about that whole universe, what's happened is they've raised all this capital, all these private equity firms, and it's sitting in their bank account. And if they don't invest that money, i.e. buy things, they got to return that capital to shareholders and they don't make any money.
Well, and those partners go find another private equity firm to park their $100 million in.
Can I just say something
Yeah.
about private equity
Yeah.
though, is that if you're gonna stay involved with that company as an employee, or if there's a lot of earnout, I mean, private equity is not always the best place to sell.
It's not, but private equity means a ton of things. We sold a platform fire protection business in Philadelphia last year. Those guys' lives have not changed. They have board meetings for sure, but and they rolled 20% equity into the new entity. They've made 5 add-on acquisitions in less than 12 months. Their money is growing. But to your point, I called an old client. We sold his business in 22 to a small family office. They changed the logo. They ran him out of the business, and it's doing this. So you're right, and that's why we're going to do calls with closed deals. And you can't tell me who they are. I'm going to look at your tombstones on your website, and I want to talk to this one, this one, this one, this one. You don't get to tell me who I talk to. I want to talk to those clients and tell me how their experience was. You're right. We can't guarantee a great, but we sure try. But you're right. Buyer beware. Well, that's a bad.
That's right.
It's
But you hit a good point. So there's a whole new group of buyers out there. I shouldn't say newer, but it seems to be more of budding. Is that family office, right? Where what they don't want to do is these family offices have said, I don't want to give my money to a private equity firm like KKR. They're going to charge me a 2% management fee on my money and then take 20% of my profits and then give me the leftover, right? So they're going, well, we have enough money. We're just going to go and do our own purchasing and just be long-term holders and be along for the ride. So there are entities out there, some better than others, that are doing it. So the point is, it's still a lot of capital.
Well, and I want to share, to your point, I think it's a very valid point. I was working on a $7 million deal last year, and the diligence process was more painful than it should have been. And we got 11 p.m. the night before closing. They had not shared a funds flow yet. We asked for the funds flow many times. They hadn't shared it. They put it in our inbox, and I said, hey, what's this $114,000 item we haven't talked about? And called my client, and he goes, he's already skeptical. I said, what do you want to do? It's a $7 million deal. $114,000 is meaningful, but it's not, 10%. He goes, I can't work with these guys. I don't trust them. I said, let's walk. Never sold that business. We're going to go back to market. But to your point, True Colors came out during that diligence process, and we encouraged them. It was hard. I work on a success fee, right? But we'll sell that business eventually. But if those spidey senses are tingling and you feel like something's off, you've got to have the power to walk away.
Sebastian, more questions from the audience?
Yes, I have another one. As a founder, what are some strategies to get an all cash deal and avoid an burnout?
I would say pray.
Yeah.
And try to build a product that Apple, Google, Amazon wants to buy.
Yeah. Would you
Or
say,
sell it for a huge discount.
did you say 10% of all transactions are cash?
All cash, right?
How much is it? Is it 80% or probably?
Yeah, it depends. Every deal is different. And
Yeah.
the best deal I've done was 90% of closing and 10% in an indemnity holdback over 12 months to satisfy those, lingering tax issues, any lawsuits. But that was sold to private equity, and they had flush with funds, and they just wanted to get it done. That's not good. It's not good.
So, if you throw a big valuation number out there and say, I want $200 million for my company. If a buyer wants it, they'll say, okay. And they'll, like I said, they'll put a lot of back end hurdles. They'll give you some money up front and say, okay, hit it. And I've seen so many entrepreneurs not hit that back end, and they've sold their company and they're not happy with it.
Be comfortable with what you walk away with at closing.
Yes.
Yeah.
Question?
Any inside?
Very good questions.
Yeah, definitely. I have more, but you tell me. It's been an hour, so happy to wrap up or keep going if you
We
like.
can go for another 5 minutes if you want.
Okay, sure thing. Jason, is there anything we probably missed that you would say if you're an entrepreneur in the crowd, right? Let's say you're in that phase, you're raising capital right now, you've got maybe a little bit of ARR. Is there anything that they should be thinking about right now from a taxation and planning perspective, you think?
Yeah, I think I touched on the sales tax issue. I think that's probably the biggest, number one. And I guess the other one too is, I know lots of people go into more of a remote workforce now. So just kind of be mindful of the implications that having employees around the country, what that means. Right. I mean, again, it generates income tax nexus. I talked about sales tax nexus, but there's also income tax nexus from a state perspective as well. So that comes up a lot as well. So just be mindful of that. Also, what also comes up a lot too is just making sure you truly understand the difference between 1099 contractors versus W-2 employees. People harp on deals, dig into that a lot. So if you have a 1099 contractor, make sure you have agreements in place that spell out their roles and responsibilities and their duties. And it really truly does define the 1099 contractor rules. Because if somebody gets in and starts digging through your company and realizes that's a W-2 employee, that's payroll tax issues, right? That now you were liable for that you didn't pay, all that, so it comes into our reduction of our purchase price with the escrows and all that, so those are big.
Now, I think one question, I think as a founders in software, at least to be aware, I don't want to talk about with all the security issues happening, and there's been more scrutiny on the security, and also the tools you're using, open source tools and whatnot. I don't know, you'll have something to talk about that to solve overall. I think that's where they also, one of the negotiations that they have been getting, going on to say, your code quality is whatever. And so I think that companies to start look at how they can be proactive about, running some security scans.
Security, privacy, the stop reports, all of that, right? I mean, making sure that you have all those in place, definitely.
And one thing I'll say also, we've got some interesting strategies that we're employing is, for example, we have some founders that got some pretty, they raised some Series A capital. They've got a pretty nice valuation. We have a ramp for an exit in the next 24 months. And so one of the things that we were able to do is we have a strategy that gives you the exposure to the S&P 500, right? Whatever the returns are there. But what this strategy also does is create paper short-term losses to the tune of 36% of whatever the value is in their portfolio. So for round numbers, if you have $1 million, this generates $360,000 of short-term losses. And what we're doing is taking that $360,000 is carrying it forward every single year. So when there is that exit in the next 24, 28 months, and they've got that capital gains bill, we carry forward those short-term losses and bank those, and then we'll offset some capital gains. So there's just some little nuanced things that's available out there that are pretty interesting. So, all right. Well, thank you so much for everybody coming out tonight and everybody tuning in at home on camera. It's great to see everybody at TiE. And I've been involved with TiE, gosh, probably my entire career now, off and on, since I first moved here to Atlanta in 2001. And it's great to see everybody. And if you have any questions, reach out to Jason, John, or myself. And I appreciate you having us. Thank you.
Thank you, guys.
Thank you.